TrendSynth, where AI meets insight.
Wall Street's primary gatekeeper is currently executing a quiet trillion-dollar systemic overhaul, marking the decade's most significant shift in financial infrastructure. Compare the global crypto market against the scale of the Depository Trust Clearing Corporation, or DTCC. As global finance's central nervous system, the DTCC processes $4.7 quadrillion annually and custodies $114 trillion in assets, dwarfing the entire digital asset market. This volume hits a bottleneck. Legacy T+1 and T+2 clearing creates a 1 to 2 day delay between trade execution and ownership transfer. This lag has a cost. Banks must set aside billions in idle cash as a buffer against defaults during the waiting period. Legacy settlement speeds act as a physical constraint on global liquidity, creating a measurable and persistent drain on capital efficiency across the entire financial system. This systemic overhaul is driven by a specific regulatory trigger from the U.S. Securities and Exchange Commission. In December 2025, the SEC issued a no-action letter to the DTCC, authorizing a live 3-year pilot program. This allows the institution to tokenize real-world assets and move them onto distributed ledger technology. The pilot targets the world's most liquid assets, including Russell 1000 constituents, major S&P 500 ETFs, and sovereign U.S. Treasury instruments. By migrating these traditional instruments to public blockchains, the DTCC intends to remove the settlement buffer entirely, enabling instantaneous T0 capital mobility. This pilot program establishes a framework where regulated institutional plumbing can safely interact with decentralized networks. The DTCC is employing a hybrid transition architecture rather than abandoning its legacy systems. Initially, trades will still clear on conventional T+1 rails. Tokenization occurs post-trade. After conventional settlement, the asset is debited from the participant's account and secured in a centralized DTCC vault, removing it from the legacy ledger. Simultaneously, a digital twin is instantly minted into a registered wallet on the public ledger. This newly minted token is a regulated security, carrying the exact same legal protections, dividend entitlements, and safeguards as traditionally held assets. This hybrid mechanism allows the DTCC to bridge legacy trade execution with the modern velocity of digital infrastructure. For its public-facing strategy, the DTCC selected the Stellar network for asset issuance and lifecycle management, with a live deployment scheduled for early 2027. Stellar's architecture is optimized for institutional asset transfer, moving away from the gas-heavy, general-purpose virtual machines used by other public networks. It features compliance-aware primitives built into the core ledger layer. Tools like native trust lines and specific clawback operations satisfy the DTCC's stringent requirements for transaction reversibility and strict transfer restrictions. The DTCC monitors this activity through LedgerScan, an off-chain system that verifies token movements in real time. LedgerScan effectively serves as the institution's official books and records for on-chain assets. Once tokenized, these institutional assets are no longer bound by standard banking hours. They can move peer-to-peer 24 hours a day, 7 days a week. Using a compliance-focused public blockchain, Wall Street achieves frictionless asset portability without sacrificing regulatory oversight. This architecture enables structural collateral mobility, a capability that will be facilitated by the DTCC's upcoming collateral app chain in late 2026. This allows institutions to shift from holding capital buffers just in case of a shortfall toward deploying capital just in time to meet specific obligations. The primary proof of this efficiency is the intraday repurchase agreement, or repo, using tokenized U.S. Treasuries. In legacy overnight repo, capital is borrowed against collateral and locked for 24 hours to satisfy the term. Conversely, the collateral app chain executes minute-by-minute funding on a shared ledger. This allows firms to borrow liquidity only for the specific window required, eliminating reliance on daylight overdrafts. The savings are quantifiable. Data from the DTCC and Fanatium projects that this intraday model could cut funding costs for large dealer banks by 50%. Furthermore, by resolving exposures intraday, banks can lower their counterparty credit risk calculations. This directly frees up billions in Tier 1 capital for other uses. Real-time collateral mobility represents a structural optimization of the institutional balance sheet, moving beyond the scope of a standard technical upgrade. Grave. This shift introduces new systemic risks. primarily through the elimination of the T+1 temporal buffer. Historically, settlement lag functioned as a systemic circuit breaker. That delay gave clearinghouses time to net exposures and coordinate liquidity backstops during a crisis. A T0 atomic settlement paradigm removes this operational cushion. Settlement is finalized the moment the trade is executed. In this environment, market shocks and liquidity contagions can propagate at ledger speed, potentially outstripping the ability of humans to intervene. Systemic risk is no longer managed by human intermediaries. It is concentrated in the correctness and security of the smart contract codebase. Despite challenges, the transition is ongoing. The lines between traditional finance and digital assets are steadily dissolving as the world's largest financial infrastructure moves on-chain. The routing of Wall Street's $114 trillion base layer through public blockchain rails moves global capital into a state of continuous, 24/7 programmable liquidity.